So I'm doing a little bit of a fast one, assuming this clicker works, because we're going to talk about a few other things generally investing in the crypto space. I'm not going to talk at all about my funds because the focus is going to be on how a traditional asset manager invests in this radical space. The premise being, or the important word in that being radical, because it's not. We're going to talk briefly about what the crypto space is and isn't, the variety of assets available, so I will cover the advertised topic, and we're going to talk very briefly about a bubble. My underlying thesis, to anyone who has a lot of experience in the fiat space, the non-crypto space, traditional space, legacy financial space, whatever you care to call it, is that all of your hard-earned wisdom, experience, and knowledge applies in full to the crypto space. Thing is, you have to be creative and flexible about how you apply it. And when I say everything, I mean absolutely everything from pink sheets to over-the-counter to anything you could possibly imagine in the fiat space applies to crypto. And what that means also is that the crypto space is not nearly as bizarre, not nearly as radically different, not nearly as unintelligible as many people seem to think it is. First, we're going to talk briefly a history of cryptocurrencies. Now, what are they not? They're not modern. Let's replace the word crypto with the word parallel. Because to most central banks, you've got this currency out there that's uncontrolled, that's running in parallel to our currency, the real currency, our fiat currency. But parallel currencies have existed literally for millennia, ever since Roman armies handed out a piece of tree bark or leather to a farmer when they took all his cattle to feed the troops. Handed him a little script that said good for $1 in Rome, the etymology of the word dollar. S&H green stamps, if you're in the US in the 70s and 80s when you bought gas, they were handed out. Frequent flyer miles, I'm sure we all have, especially at this conference. Hotel points, which Bobby Lee mentioned yesterday. Credit card points, same thing. There are analogies for what cryptocurrencies are throughout history. They're not particularly unique. Of all major fiat currencies, the number's about the same, some variety, but 96% of those currencies are not represented by any physical manifestation. So when people talk about, we shouldn't call them crypto assets, we should call them digital assets, it's an interesting statement, you can perhaps do that, but when you change from crypto to digital, you include almost all fiat assets on the planet Earth. There's not a single fiat currency anymore that's backed by a hard asset. Paradoxically, there are cryptocurrencies that are backed by sand, backed by granite. There are a dozen of them backed by gold. There's one that's going to be backed by diamonds that's going to emerge. When did this start? During the Great Depression, and most of this movement was led by the United States because at that point in time, the United States represented around 42% of the GDP of the planet, currency being representatively powerful. People don't realize that as of June 6, 1933, it was illegal to own gold in the United States. It was a crime. People were arrested, put to jail, sent to jail, and their gold was confiscated. That process was completed in 1971 when Richard Nixon took the United States dollar off the gold standard. Bretton Woods collapsed, the 1946 treaty in New Hampshire, and you had total free floating exchange rates. They're not novel particularly. And here's a good example. Notice 1971, when Nixon took the dollar off the gold standard. In 1974, several Greek colonels decided to invade Cyprus. They took it over. Turkey invaded from the north. You had the Green Line where they finally settled up. The Green Line runs right through Nicosia, which used to be the unified capital, and the airport. And so now you have 3 international airports on this little island. You also have a new currency that was created after 1971. 1 million Cypriots on a single island created this currency. Now, the Cypriot pound existed before then, but it had to be totally restructured because there's a totally new government. The exchange rate was nominally greater than the US dollar, which made it one of the very few currencies in the world that could say that. So the question is, if 1 million people who happen to be co-located on a single island can create a currency backed by nothing, why can't 1 billion people who aren't on the same island? So there are analogies for what cryptocurrencies are very much throughout fiat history. They're not revolutionary. You had e-gold in the United States where a gentleman bought a little pile of gold, put a video camera on it, broadcast that picture. Here's your gold. Here your new currency is now backed by gold, taking a massive step backwards to actually Roman Empire days by doing something like that. But people liked it because there's an attraction, there's a historical attraction to gold, and not everyone understands. How can you have a currency that's not backed by anything? And this well predates Bitcoin or anything else. It's not even the first, Bitcoin is far from the first cryptocurrency. As near as I've been able to tell, it's probably the 9th. But it was the first one that had traction because it learned from these mistakes. The inventor, the owner of e-gold, was arrested by ATF, the Bureau of Alcohol, Tobacco, and Firearms in the United States, along with the Secret Service. Who is Satoshi Nakamoto? He, it, she, them, no one knows. There's a reason for that. Wise fellow. He didn't want to be arrested. The first cryptocurrency is actually about 25 years old, and frankly, cryptocurrencies have a lot in common, not so much on a technical basis, but from an operational basis with SWIFT. All due respect to Ripple and XRP. Now let's talk about the focus of the speeches presented in the program, and that is the variety of investments in this space. There are an enormous number of ways to invest, far more than most people realize, even based on the prior two speakers, far more than they realize. You can have direct hold on for dear life. This is also known as buy and hold, but you buy it yourself. And the second way, and as I built this, it's generally an increasing complexity, and I didn't realize till I was done that it's also sort of chronological. Not exactly, but generally. There's an index, hold on for dear life, a single currency, like the Bitcoin Investment Trust, which is an interesting investment because it simply allows people to enter the crypto space easily. But because otherwise it's rather difficult, or people perceive it as being difficult, the Bitcoin Investment Trust trades at a significant premium to the underlying asset, which, given how easy it is for someone who's climbed the learning curve to buy that underlying asset, makes no sense at all. But not everyone has climbed that learning curve. So that's the second very common way of investing in the crypto space. You have indices. My company has launched the first professional index, and then we launched a share class that mirrors that index. There are other indices that are more informal, if you will, that have been launched for a while, but none of them included the entire range, as ours does, the top 30 by market cap. Direct trading, buy low, sell high, what we want to do in all circumstances. But contrary to what the modern or the contemporary press would have you believe, especially after CME and CBOE came out with their futures contracts, it's been possible to short Bitcoin and all major cryptocurrencies for years. We shorted Bitcoin 3 times in October and did very well on 3 different shorts. We shorted once in January this month, and we did very well on that as well. And we didn't go to the futures markets. We're shorting directly on exchanges. It's been possible to do that for a long time, leverage long. All of you can do that directly today. Then trading funds. One of my share classes in my fund just simply trades and invests in various ways in a variety, 30 to 34 a month in both BTC, but mostly in altcoins. Private equity. Private equity has also been available for 3 or 4 years, a variety of funds that do that. And I don't mean ICOs here, although from a philosophical standpoint, there is certainly some overlap. But by private equity here, I mean equity only, traditional equity only, and there are a number of very good funds in the space that can do that. ICOs, so what is an ICO? It's mutualized, decentralized, real-time price formation, seed, VC, or PE fundraising. Fascinating. It's revolutionizing both the buy and the sell side. The sell side, it's revolutionizing because the first ICO, for instance, we bought was run by a team in Estonia. There is no way, unless they moved to a suburb of San Francisco, that they could have raised the kind of money they did. So it revolutionizes the opportunity for people to raise money for good ideas they have. And on the buy side, instead of getting 5 investors with $10 million each, you get 5 million investors with $10 each. It totally changes the paradigm. And as a result of that, securities regulators are having a very difficult time figuring out how to regulate ICOs because it's easy to regulate 5 guys who are doing 10 million each. It's a lot harder to regulate 5 million people from 26 different countries who are putting in $10 each. It's not practical, it's not cost effective. What do you do? Fixed income, it's another share class that my fund offers. It actually has, as far as I know, it's the only fixed income share class or fixed income product in the crypto space. It already does exist based on peer-to-peer lending or lending from traders to traders on exchanges. Remarkably, in early August of this year, the interest rate on peer-to-peer lending was 500 basis points. And I tell this to people, so 500 basis points, 5% a year, what's that? That's no big deal. Except it was 500 basis points every 24 hours. We stopped trading in our Class T, our trading class, put everything into lending. It didn't last all that long. It was only about 3 weeks. But 5% a day for 3 weeks, you can actually make pretty decent money. Mining or crypto real estate. Mining is a pseudo-fixed income investment class. The reason I liken it to real estate is because I run actually a multi-generational family office, and we look at real estate very much like fixed income, except there's a little bit more variability built in, and there's also appreciation, which you don't have in fixed income. Mining is a little bit like that. It plays that sort of role in a crypto portfolio. And the idea of putting mining, not necessarily directly mining, but there are all sorts of ways to indirectly invest in mining, which I would encourage any portfolio based on the crypto space to include. And we have our Class M, which is actually a mining class and does exactly that. The last, chronologically and in terms of complexity, or in terms of risk anyway, multiplier effect, is the greatest, and that is futures. Again, contrary to what you may have read in the popular press, CBOE and CME were not the first two, plus Cantor and NASDAQ, were not the first organizations to offer futures trading. LedgerX was licensed in July of last year, and started trading in September of last year. It was a big day for LedgerX when they had $1 million worth of trading in futures, something that CME destroyed in the first 10 minutes of trading. It's a question of scale, popularity, and being well known, and the popular press grabbed onto the 2 and then later 4 well-known entities that were offering futures trading, completely ignoring that futures trading and shorting and a whole bunch of other things had actually been possible in the sector for years. Funds of funds, a combination of all the above. There are a number of these emerging. People generally approach me because we have some totally unique share classes in the space, and also because I run a fund of funds. So I keep getting asked to be on the advisory board of these. Last point, and I'll open the questions, is a bubble. Now, Jamie Dimon's famous quote about Bitcoin is a bubble, Bitcoin is worthless, or whatever, is quite fascinating because I like Jamie Dimon as an executive. He's very, very good, and his quote only focused on Bitcoin, not the crypto space, and you have to separate those two. But with that quote, he not only showed that he did not understand crypto or Bitcoin specifically, which I can kind of understand, although I think he should have kept his mouth shut. Most importantly, he showed he had a very poor understanding of classic financial history. Here are the main stages of a bubble. And pretty standard chart in the public domain. So let's see whether, by historical standards, Bitcoin is a bubble. This is the tulip bubble. Now, it's a bit of a non-smooth graph because there's actually not a lot of data based on the tulip pricing for the 2.5 years that this was going on. This is the South Sea bubble, the speculation on finding all sorts of treasure in the newly opened portions of the world, at least newly open to the West. This is one of my favorite ones in terms of doing this bubble research because that's the Dow Jones Industrial Average during the Great Recession of the 29 and 30s. This is the dot-com bubble. The 2008 financial crisis, it's a linear scale here. All of them are linear, but this one actually doesn't seem to be all that much of a bubble because it wasn't, as a percentage basis, that much of a drop. And the last is Bitcoin. So to compare these, and this is a preview of an article that we've got coming out that I think will put the bubble debate to rest, you have to overlap these. And here you can see what happens. What we've done here is we've lined up the starting points. There are other ways of analyzing this data. I'll show you a couple of them. We explain a lot of them in the article. But as you can see here, if you took this one piece, perhaps, and that is the 2013, not 2011, as someone said yesterday, the 2013 Cyprus jump, and it settled back. And then you have China and the PBOC attacking Bitcoin really for crypto for the first time, plus Mt. Gox. And then you have the latest one. So within this, you could conceivably find bubbles. And in the article, we're going to take that apart and blow it up and overlay it on the others. But if you look at that just from a visual standpoint, much less doing any statistical analysis, it's clearly that actually there's not much commonality among all of those bubbles. And there's virtually nothing in common with Bitcoin. This is now a log scale, and this is multiples of the starting point, with the starting point being 1 to avoid the multiplication by 0 problems. And again, you can see here, there's a little bit more commonality with the Great Depression and the dot-com crisis, which actually sort of makes sense, right? Because they're both based around the stock market. Some commonality with Mississippi and let's see, what's the black one there? The South Sea Company, and a little bit also with the tulip bubble, which also sort of makes sense because they're all sort of traded in the same general fashion. But again, what you see is that the clear outlier here is Bitcoin. Lastly, again, this is a logarithmic scale. It's percentage increase from the starting point. And here we see the same groupings together. There's a bit more commonality where you could claim, okay, it's similar to the Mississippi Valley Company, or it's similar to the South Sea Company, but it drops off. The broken chart here is the tulip crisis because there aren't a lot of data points available. The most important thing from a statistical standpoint is here it's concave, here it's convex. You're going totally different directions. So the conclusion we reach, and it happens to be the one that we wanted to reach, but the data support it tremendously, is it's not a bubble. Unless you're going to radically redefine a bubble into something else. Just statistically, it doesn't fit. Second last chart is this. It's sort of interesting, putting things into scale. Now, all cryptocurrencies at 312 was a little bit low, even yesterday when it dipped below 500 for a little bit. But I just checked, Amazon is actually above 600 and Apple is above 800. So relatively speaking, even though this is a couple months old, the data relative to one another is actually quite good. And you can see that there are two individuals whose combined wealth exceed that of actual Bitcoin market cap. It's not that large. Cryptocurrencies, even though they're hovering around $500 billion, in the overall economic context, are very small. I used to tell people cryptocurrencies are not a pimple on a gnat's ass. Now they are a pimple on a gnat's ass. Soon they'll actually be a gnat, but that's it. There's a tremendous amount of growth available. It's not going to be even across the board, but it's a very, very small part of the financial ecosystem. The other bubble we could add to this, or the other circle, rather than using the word bubble, that we could add to this is the number of derivative contracts, or the value of derivative contracts that are denominated in US dollars, which is actually unknown with any precision because there's no central registry, but it's estimated to be about $450 trillion. And Bitcoin is less than, or the cryptocurrency space in its entirety is less than 0.2% of that. So it's not a large space. Correlation. Just say a couple words about correlation. If you're an asset manager, why on earth would you go into something as risky and as early stage as crypto still is? And the answer is basically this word. Of all major asset classes, if I can be so bold as to put cryptocurrencies into a class of major, it is the least correlated. What oil does, what stock futures do, what the US dollar does, what the euro does, what the Swiss franc does, whether it's pegged to the euro that week or not, has nothing to do with the behavior of the crypto space. Now, unfortunately, within the crypto space, as an investor who believes in portfolio theory and diversification, there's way too much correlation in the space between Bitcoin and everything else. It's only 33% of the market cap, but that's down from about 85% a year ago and from 98% 2 years ago. But if you look at what happened over the last 3 days, when Bitcoin went down, 94% of the top 100 coins went down with it. When Bitcoin went up, as the recovery started about 14 hours ago, 98%, and in fact, you can really say 99 because one of the exceptions was USDT, US dollar tethers, which for a variety of reasons doesn't really count as a cryptocurrency. All but one in the top 100 went up. That's not good. They went up by different amounts, they went up at different times, but still there's way too high a correlation within the crypto space, which is a problem. But the correlation between crypto and fiat is virtually non-existent with one exception. And that is, and it's a good exception from the standpoint of being a portfolio manager. That is when there is a major economic crisis in certain parts of the world, it'll have a direct effect on Bitcoin. And we are also seeing that enter the military realm, which is sort of interesting. In 2013, when the Cyprus crisis happened, you saw Bitcoin go from about 60 to 266, back down to about 80. And so there was a direct crisis outside the space that had an effect on cryptocurrencies. Speeding up forward, I'm not going to go through a lot of these examples, just one more. When Kim Jong-un announced that he had intercontinental ballistic missiles, ICBMs, capable of reaching the United States, you didn't see crypto trading jump in the United States, except he also said, we're going to fly over South Korea and Japan to get there. And what you did see was about a 12-13% increase in the price of BCC within 4 hours of that announcement. Most of it was driven by trading volume in South Korea and in Japan. So there is some correlation between negative global economic events and the price, at least of the leading cryptocurrencies. And that makes sense if you want to be able to move your assets, move your money around. If you did that in World War II, you had to put it on a big wagon and drag it behind you. In the modern day and age, you take your currency, you flip it into BTC or flip it into some other major currency, and it's gone.